This is Las Vegas Real Estate Now, where we bring you the 3 E's: educate, empower, and engage. I'm your host, Harvey Blankfeld, along with our co-host, Shelley Brown, and we've been selling homes here in Southern Nevada since 1988. Shelley and I are also very proud to be part of the Real Estate Radio Network. That is a national network of local real estate professionals delivering timely, balanced truths about local market conditions. And with us in studio, we have Mickie Salgado. She's the escrow manager at Equity Title. And first, we need to explain what is FIRPTA? What is that?
Well, FIRPTA is a pain in the neck, first and foremost. But FIRPTA stands for Foreign Investment Real Property Tax Act.
Okay. So this is when somebody's not a U.S. citizen, they buy or sell property, there's special taxes involved.
Absolutely. All foreign sellers are subject to a tax withhold based off the sales price of the property. We have to, of course, hold 10% if you're an individual and 30% if you are a corporation or an LLC to ensure that there are no capital gains on the property that need to be paid.
Okay, so is it 10% of my proceeds, 10% of the sales price, or what?
10% of the sales price, again, if you are an individual seller. 30% of the sales price if you're a corporation or an LLC.
If you're a U.S. corporation or LLC or a foreign corporation?
Foreign corporation,
So if you're a U.S. corporation, LLC,
you're exempt.
You're exempt. You don't have to worry about it.
Absolutely.
Are there other exemptions that we can talk about, or anything other ways you're exempt?
Absolutely. The property can be exempt if the sales price is under $300,000, and it's going to serve as the buyer's residence.
Okay, so even if the seller's a foreign national, the buyer has to buy it as an owner-occupant.
As an owner-occupant. They have to. They don't have to occupy the property 100% of the time.
Right.
But they do have to occupy the property. It's 50% of the time that the property is vacant or something like that. 50% of the year, basically.
Okay.
They can't rent it out.
Okay.
And they can't flip it right away.
And that money still belongs to that person. It's just sitting at the IRS, much like payroll withholding is. You know, when you have your taxes deducted from your paycheck, that money's sent off to the IRS. It's your money to use to pay your taxes at the end of the year.
Correct.
And that's what's happening here too, right?
Absolutely. Once the seller has either applied for a tax identification number or they already have a tax identification number, they follow the same guidelines as filing their taxes as a U.S. citizen. Once they do that, either all of the money will be released to them or a portion of the money.
Whatever's, but minus the taxes due, whatever that might be. Here's the kicker for this thing, though. If we don't do that, as the property manager, we're responsible for the tax. If you guys, if the buyer doesn't confirm that the money's been withheld for this seller, the buyer is responsible. Is that not right?
Absolutely.
See, that's the scary thing, guys.
With FIRPTA, the buyer has to act as the withholding agent, or they can designate somebody to act as the withholding agent. But ultimately, the buyer is responsible for that tax money because, of course, the IRS can't go back on a foreign seller to try and collect it, so they have to collect it from the buyer.
That is so wrong. How would a buyer might not even know that the owner of the property was a Canadian citizen?
Okay, and that's why on our contracts now they have those check boxes that the seller, when you send that offer over to the seller, they have to let you know whether they're a foreign national.
One way or the other.
You've been listening to Las Vegas Real Estate Now with hosts Harvey Blankfeld and Shelley Brown. Please tune in every Saturday at 11 a.m. right here on News Talk 720 KDWN.